Activity during the first quarter of 2017 has further validated the digital advice space, as additional established firms like Wells Fargo, John Hancock Retirement Services, and WisdomTree, among other well-known industry names, have begun rolling out their own digital advice platforms. This acceleration in rollouts from some of the largest providers is likely to energize this segment, ushering in a Robo-Advisor 2.0 of sorts. And with these new platform rollouts, providers are clearly establishing a new framework for what a Robo-Advisor should look like. What will Robo 2.0 look like? I'm Roger Stamper with Fuse Research, and today we're going to take a few minutes to discuss the future evolution of Robo-Advice. With $97 billion in assets in the first quarter of 2017, Robo-Advisor assets have nearly doubled from the $50 billion at the year end of 2015. Despite this growth, only 6 firms boast assets in excess of $1 billion, representing 97% of all Robo-Advisor market share. Vanguard maintains the lion's share with nearly 60% of the market. The other 5 firms with $1 billion or more include Schwab, Betterment, Wealthfront, Personal Capital, and BlackRock's Future Advisor. Fuse believes that many of the newest iterations of Robo-Advice are moving towards a hybrid approach, not just in terms of the technological elements that drive the robo industry, but also in terms of providing a human component at varying levels of service and scale. What's interesting is how both traditional wealth managers and digital advice providers continue to find ways to complement each other as the space evolves. In fact, over 40% of the digital advice providers that we track offer some form of human interaction, a figure that is growing quickly as more traditional players come on board. Raymond James, for example, built a proprietary offering to pair with its advisors focused on client communication and analytics. On the other side, Betterment now offers financial planning for clients at certain asset levels. As the marketplace grows more familiar with robo-advice and wealthier investors navigate to robo platforms, more sophisticated products, aside from passive ETFs, will come into demand. Fuse has found that some robo-advisors are using active management within their fixed income sleeves or introducing more strategic beta into their portfolios as well. While other robos with advisor-facing offerings are beginning to offer model portfolios from active shops. As the acceptance and number of platforms swells with hybrid offerings, firms looking to act in a fiduciary capacity will begin to realize that low cost doesn't always mean it's the best option. Therefore, Fuse sees this segment of the industry naturally moving towards more open architecture in terms of both product selection and model recommendations. And as the industry matures, combined with more open architecture platforms and additional established brands entering the marketplace, Fuse anticipates that assets will grow from the $100 billion currently to surpass over $800 billion in the next 5 years. Fuse expects that as most of the larger traditional players complete their moves into the space, they will, by default, come to market with hybrid offerings since they already have human advisors. From there, the expectation is that they will continually adapt and differentiate themselves from competition on both the technological and human aspects of advice. We expect human interaction to go beyond just a video conference or phone call, finding its way to physical locations as well. On the platform side, we expect to see greater open architecture, use of non-passive products, as well as more differentiated services for both clients and advisors as we enter this next phase of digital advice. Thanks for taking the time to view this video. If you have any questions about the topic we covered today, or would like to learn more about our current research, please let us know. Thanks again, and have a great day.